Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And just a reminder, I've got a new report summarizes the evidence-based approach to investing in both property and shares and really highlights, I guess, the sort of key thoughts, topics, blogs and so forth that relate to those investment strategies. The download link is in the show notes. So if that's of interest, check it out. And most importantly, if you know of anyone that would benefit from reading it, please share it. Hopefully there's plenty of thought-provoking information in there for others as well. Okay, so welcome to today's Q&A episode. Let's start with a question from Josh. So Josh writes, a lot of your questions relate to high-income, high-net-worth clients. What would be the best way for the average Joe, PAYG, single-income family that has low borrowing capacity to invest? I'd prefer to invest in property but don't want to buy under investment grade. Is it worth buying a lower price property in a regional location, waiting, saving a deposit so that you can get into a capital city market, invest heavily only in the stock market, just save cash, live investing, sweat equity through renovating the family home? And Josh says, for context, we currently have a family home in Melbourne area with a small mortgage, single income family of 5 and PAYG employee. Thanks for your time. So Josh, you're right. I mean, that's really where I've spent most of my time over the last 20 years is advising higher income, higher net worth clients. Unfortunately, because of the cost of financial advice, that's where you've got to kind of skew towards, because the overhead cost, just the compliance costs, we did an exercise about 18 months ago, worked out it costs us about $3,000 a year just to look after a client before you even do 1 hour of work. Again, just from a compliance overhead cost perspective. And so therefore you've got to really charge a minimum fee of $5,000, cover your time cost as well. And you can only really charge that to people that have complexity, because there's no point charging someone $5,000 if there's not enough scope for us to add $10, $15, $20, $100,000 worth of value. So unfortunately that's where it is. And, a lot needs to change in the financial advice industry. But just to give not only you, Josh, a bit of background, but also listeners, that's where we're sort of skewing. But it's a great question. And, one of my ideas, of course, my strategies and blogs and podcast episodes are really aimed at that sort of higher income earner. The idea is that hopefully, those principles shouldn't really change to lower income earners. I guess the application of the principles might change in terms of price points and the amount we're investing in those sorts of things, but the principles and methodologies don't really change. So the first thing I would do is refer you to an episode I recorded in late March 23. The title is How to Buy the Highest Quality Property Within Your Budget. And in that episode, I outline sort of the investment grade principles in terms of an asset with a high land value component, a location and type of asset that has a strong history of growth, and then also the third element being scarcity in terms of land supply in the surrounding areas where that subject property is. And then scarcity somewhat, as much as you possibly can, in dwelling style as well. And those three attributes are what makes a property investment grade from my perspective. But we can apply that to really any market, so even markets outside of blue chip suburbs, for instance, to be able to buy the best quality property that we can buy. So check that out. Also, senior advisor in our business, Campbell Wallace, is going to record an episode on this podcast that we'll publish over the Christmas. He hasn't recorded it yet. Anyway, the subject of that episode will be how much capital growth do you need for property to be a better investment than shares? So really, we all know, and anyone that's been listening to this podcast for any period of time realizes that one of the big benefits of investing in property is really the gearing you have. So it's not really property per se, but it's really the gearing in the investment strategy. And so at what point does that benefit of gearing dilute if you're investing, you're starting making a compromise in terms of property? It's an excellent idea for an episode that Campbell came up with. So I'm very much looking forward to, reading the analysis and looking at the analysis that he does in order to do that. So that's of interest. I'd certainly say check that out over the sort of December, January period. So what would I do if I was in your shoes, Josh? Well, look, it's hard to say because, you give me a brief sort of one sentence overview of your situation, but I guess it's, what about your risk profile, your time horizon, all those sorts of things. And I appreciate, and I'm not trying to encourage people to send me War and Peace in terms of these questions, because the more succinct they are, the easier it is for me to answer them. But, they're the sorts of things I would be thinking about. But if I answer it just purely from my own personal perspective, if I was in your shoes, what would I do? I would buy the best quality property, the highest quality property I could afford in my budget. I would occupy it, and then I would renovate it cosmetically as much as possible. I don't really want to do anything that's not cosmetic, because it's the cosmetic improvements that will really improve the value, unless I'm adding, say, a bedroom. So if I buy a 2-bedroom house, an old sort of 50s, sometimes you find those 50s 2-bedroom homes, and I add a couple of bedrooms at the back, I'd be happy to do something like that, because I think that adds a lot of value. But essentially, buy an asset that you can really add value to, and do it as cost effectively as possible. So I would do most of the work myself, or as much as I possibly could, of course, but try and stick to the cosmetic stuff, occupy the property for a period of time, and then upgrade. So really buy a great asset, hopefully at a great price, that has the attributes that are going to drive capital growth, make improvements to that asset to increase its marketability and hopefully generate some equity on a tax-free basis, and then keep doing that. That's what I think I would do. Now, does it suit your family circumstances? Will your family appreciate moving home every 5 years? Probably not. So there's downsides to that strategy. And if you did want to do that, so that is, use your home to really build wealth and equity, then maybe it's investing in property, but trying to make as fewer compromises as possible. Subject to, Campbell doing that analysis. I don't want to steal the topic away from him. It's a fantastic topic. So let's see what he comes up with in terms of what capital growth do you need, because that could really frame my answer to your question as well, Josh. But thanks very much for it. Okay, next question is from Andrew. Andrew says he's enjoying the podcast after being relocated to the Philippines. For work, I find it useful when navigating the Australian market. Would you have any investment advice for someone that's a non-resident but still looking to invest in Australia? This may be either property or shares. Money is not being put into super, as I'm not employed by an Australian company. So, Aaron, it's a good question, and it's a bit of a difficult one. I would say, if I'm going to give advice to a non-Australian tax resident, that my advice is going to be influenced substantially by tax outcomes, at least from an Australian advice perspective. Now, of course, if you are a tax resident in the Philippines, you're going to need to consider what consequences of your decisions that you make from an investment perspective in Australia, do they have any consequences in Philippines, or for other people that are non-residents are listening to this, wherever you are living, of course, that I can't comment on. But when it comes to non-Australian tax residents, the big downside to investing in residential property is that you don't get the 50% CGT discount for the number of days that you were a non-resident, non-Australian tax resident, relative to the number of days you own that property. So, for example, if I magically become a non-resident tomorrow, and then the next day I go and buy myself an investment property, I hold that property for the next 10 years while I'm a non-resident. In 10 years' time, I move back to Australia and continue to own that property for another 5 years. And then after that 5-year period, so a total of 15 years of ownership, I go and sell that property. Essentially, when I come to work out the capital gains tax, for 2/3 of that time, I've owned that property as a non-tax resident. So I'm only going to get 1/3 of the 50% capital gains tax discount. So essentially, that means that while I'm overseas and working, I'm going to end up paying up to 47% of the capital growth in tax. And remember, we want to invest in property predominantly for capital growth. So it's a really tax inefficient asset. Whereas if I invest in managed funds or shares, there's no capital gains tax on that while I'm a non-resident. So if we just hold the returns constant between property and shares, one's tax-free and then one's, you're paying almost half of the gain away in tax. So if I'm developing a strategy for a non-Australian resident, save for potentially buying a family home, a property that's going to be a family home, and they expect to return to Australia relatively soon, sometimes we will do that. But pure investment property, not that keen on, and mainly because of the tax consequences associated with that. Now, there are exceptions to this, of course, and we need to really think about if you're away from Australia for an extended period of time, you can really easily get priced out of the property market very quickly. So we need to think about that. So it's, not just tax, but a tax is a really big consideration. So I don't know what the answer is, Aaron, because I don't know your situation, but I think you just want to be careful about what are the Australian tax consequences when coming up with your own investment strategy. Okay, next question is from Peter. Peter writes, my wife and I have separate industry super fund accounts, plus some shares and cash, total worth $1.4 million. I'm assuming, Peter, you're referring to the shares and some cash outside of super, I think, but anyway, that's the assumption I'll make. Anyway, Peter writes, and we're approaching our retirement age, so we want to have a steady and strong cash flow starting in a couple of years. Should we combine all this into a wrap platform environment? Well, if you have a wrap product, a super wrap product, you're still going to have it in two separate accounts. The only way you can have one wrap product is if you start a self-managed super fund, and then you can put it all into one account because the accountant then has to keep track of the member account. So, how much is related to you and your wife or you and your partner, whatever it is. So that's the only way you could do that. And you wouldn't establish a self-managed super fund just for that ability. So even going to a wrap platform product, you and your spouse are still going to have two separate accounts. I guess the other question would be, should you take some or all of those shares and cash that are outside super and make a non-concessional contribution and move them into the super environment? Well, the main downside there's two considerations typically when making that decision. The first one is, are there any capital gains tax consequences? So there won't be with the cash, of course, but if you've got shares and they're sitting on, large unrealized capital gains, and if you're only a couple of years away from retiring, then I'd probably say don't do it now. Move those shares after you've retired and in the full tax year that you don't have any employment income so that you minimize the capital gains tax cost. So that the CGT consequences of moving those assets inside super, that's one thing you're going to think about. And then the other thing is that you're going to lock that money away. So, that's one of the downsides with super is that it's very tax effective environment, but we can't get access to it until after age 60 if we stop working or 65. So again, but if you're a couple of years away from retirement, locking that money away per se isn't really that big a deal, but you're still going to have two separate accounts. Now, whether you move from an industry super fund to a wrap platform, if you've got $1.4 million, really depends on which industry super fund you're at and what your percentage fees are. But also then you got to think about, okay, I've got to pay for financial advice actually. So even if you went to a wrap platform and you didn't have the skills and experience to manage that money yourself, then going paying an advisor, if all they're doing is looking after that part of the portfolio, it's probably not worthwhile. And I think in that situation, I'd probably say to you, look, stay at the industry super fund, move the shares and cash into super at some point in time, whether that's now or the year or two after you retire, whatever's going to be more tax effective is most likely the right answer there, Peter. But thank you very much for your question. Of course, it's not specific advice and none of these answers are, but I'd just like to sort of talk to, some of the considerations that I'd think about when faced with those sorts of questions. Okay, next question is from Ben. Ben writes, my father has some inheritance and wants to help my adult sister in her mid-30s buy a house. He's mentioned going halves with her as tenants in common. I should mention that he's also recently sold his own home after a long separation and currently renting, although has plans to move in with his new partner in the future. My concern is that he's in his mid-60s, nearing retirement without any meaningful super, so the investment would likely affect his ability to qualify for the pension and any future care needs when they might arise. Could you suggest the best way a parent can help their adult child purchase a house if they're nearing retirement and would be relying on the pension for income? It's a good question, Ben. Of course, with any Centrelink benefits, there's income and asset test as well. So even if the amount of ownership of the property is below the asset threshold, there's still going to be some potentially deemed income associated with the investment. So you're right, it's probably going to have a negative impact on age pension and any other sort of benefits, Centrelink benefits he might enjoy. I guess the other thing too is, I get the idea that a parent wants to help his daughter, that your father wants to help his daughter, but maybe the best answer is help yourself first so that, you don't create any issues for your children down the track. So if he was to give all his money away to one child, then he's going to put himself in a position where, he's going to have a tough financial position, and then that's going to impact on the rest of the family as well. So I think if he was my client, Ben, I'd say, look, make some smart decisions for yourself, particularly if you don't have a lot of super. You want to make sure that money is well invested, safely invested, and so you're putting yourself in the best financial position for the future as possible. And maybe you can't really afford, in inverted commas, to own half of your daughter's house. And so that's probably answer is don't do it. The other way he could potentially help her, I mean, I guess it depends on if she needs help because she doesn't have enough borrowing capacity, or if she needs help because she doesn't have enough deposit. Because if it's not enough deposit, then maybe what he could do is give the bank a term deposit as additional security. So that means that your sister would go and buy a home. Let's say she wants to buy a home for $400,000. She doesn't have a deposit, but she's got strong income. She can afford to borrow $400,000. But of course, the bank's not going to lend her 100%. So your dad then comes and says, okay, here's a $100,000 term deposit. Actually, need to be a little bit more than that. Let's say 150. Here's a $150,000 term deposit that you can use as additional security. So you lend my daughter $400,000 that she needs to buy the property, and the bank's happy with that because its security is the $400,000 property plus the $150,000 term deposit. It's got $550,000 worth of security, and that's enough to secure a $400,000 loan. The benefit of doing that is that in the future, all the bank needs to do is revalue that property, and as long as the value has risen, of course, that's not guaranteed, but I mean, property tends to generally rise as, time elapses. Then your dad can get his deposit back, his term deposit back. And so that's the way he's going to bridge that period where your sister hasn't had enough equity. But if it's really about an affordability issue, well, I'd probably say, based on the very small amount of details you've provided me, your father's not really in a position to be able to make a decision around money that doesn't prioritize his own personal financial position and investment returns. Okay, next question is from Gus. Gus writes, I would like to know your thoughts on the most tax-effective way to invest in shares. My wife and I are in our early to mid-40s. We have an investment home, our only home, in joint names, and we've got a share portfolio in my name only. Our aim is to retire and live off share portfolio dividends and capital at around age 55. What is the most effective options? Create a joint account, another account in my wife's name, or just keep investing in my name and transfer them into my wife at some time in the future? We both earn a similar wage. I currently have about $140,000 and I'm adding $1,000 per fortnight, and I'm looking to increase it soon. Another consideration is the fact that I am in a tax-free super scheme and have no concessional super cap. I would like to work for a couple of years and put all my wage into super if I have the capacity. So I think what Gus is referring to is a untaxed super scheme, which means that you don't pay contributions tax when you make the contributions. That tax is subtracted when you take the money out, like when you retire, of course. So, you get defer the tax, not really avoid it. But the deferral can be, depending on your age, for a long period of time. So they're pretty good schemes. Although, I'm pretty sure they're all closed now. So don't get too excited if you're not part of an untaxed super scheme. But if you are, realize it's a pretty unique benefit. Okay, so it's really about, how do we tax effectively invest in shares if we know we want to then use that money in our mid-50s? And that's a really relevant point. The things that, from my own experience in working with clients over the last 20 years, is that you don't want to be too overly focused on the now, because the now could change any time. So what I'm talking about there is the risk of making a decision based on the relative taxable incomes in a family unit today is that they change in the future, and then you're in a position that's suboptimal. And then also that you want to have the flexibility that if things do change, that it doesn't really upset your tax strategy and investment strategy too much. Now, I know Gus said that their wages are relatively similar, so, that's not a big deal at the moment. But what happens if they aren't similar in the future? You just don't really know what's going to happen. So that's one thing. And I guess we think about the tax liabilities, what we really need to do is think about tax liabilities in kind of two stages of life. So in the accumulation stage, you have to be earning dividends off the share portfolio, probably some imputation credits, some tax credits. But on 140,000, that's going to be some money, but it's not going to be huge in terms of tax liabilities. The other thing, though, will be at age 55, it's very likely he's going to need to use both capital and income in order to fund an early retirement, whether that's partial retirement or full retirement. And in that situation, you do want to have the flexibility to sell the investments that are most economical to sell, if you like. That's probably the best terminology. So I guess when I look at a portfolio, I think, what do I want to sell? I certainly don't want to sell anything that I think's undervalued or anything that's got exposure that I think's going to earn above average returns over the next 5 to 10 years. What I'd like to sell is the sectors of the market that I think are fairly priced or overpriced. But when I'm faced with that, I've of course got to think about capital gains tax. And typically those sectors of the market that are either fairly priced or overpriced tend to be the ones that also have a large capital gain. And so then in that situation, if the desire then is to reduce tax, maybe end up selling the investments that you don't really want to sell. So again, having flexibility when you're in your mid-50s, when you want to use that portfolio to sort of fund an early or partial retirement, is an important consideration. So I guess what I'm saying is that it is a difficult decision, but I would like to have something that's going to give me a lot of flexibility. I think there's two ways to think about it, particularly given you're on a very similar wage at the moment. And I'm going to contradict myself a little bit. Let's make the assumption that you don't think that's going to change, or if it does change, it's not going to put you in a different tax bracket. And if that's true, then there's two options here. You could just have a joint account, and that way that you can, well, I wouldn't have a joint account. I would have a account in each of your names. So joint account's not really going to work because you're not going to be able to choose which taxpayer will pay the tax. Instead, what I'd have is an account in your name, an account in your wife's name, and I would mirror the portfolios so that then if I had some certain exposure, I could then decide I want to sell that exposure, but whose name do I want to sell it in? That'll give me some flexibility. The other option would be a family trust. Now, I wouldn't normally go to the hassle of and cost of establishing a family trust unless I thought the investment portfolio was going to be close to $1 million. So if I thought it was going to be close to $1 million in the next 10 to 15 years, I'd probably put it in a family trust. And so I think I haven't done the projections in your situation, Gus, but if your starting balance is 140, you're going to invest $26,000 to $50,000 a year over the next 10 years. It's conceivable that your portfolio might not get to $1 million, but it might be relatively close to that amount, certainly north of $500,000 over the next 10 years. I would start to lean towards, it just depends on how really sensitive you are to fees, but I would lean towards putting it in a family trust. And you can minimize the cost a little bit by having you as individual trustees instead of having a corporate trustee. But at least that gives you the flexibility in the future that if your income changes, even from year to year, you can make different distributions. And then when you're in your mid-50s, when you want to start drawing down the portfolio, again, you can optimize distributions and capital gains. I don't know if you've got children and whether you'll have grandchildren in the future, but all these, if you do, you've got even additional potential ways to reduce the tax. So it's a difficult one though, right? Because, you want to be sure that you're going to be better off. The difficult thing is we don't really know because we've got to provide for change or the possibility that things change in the future. But how do I, as an advisor, quantify that and then come back to you and say, oh, definitely you're going to be better off. If it was my money, I can tell you what I'd do. I'd establish a trust because I think the cost to run the trust over the next 10 years, that is ascertainable. And I just think it's more likely than not that you'll be better off with the family trust, plus all the other benefits in terms of estate planning and so forth. So I felt like I prattled on with that answer, but I always want to just give you a little bit more commentary about what I'm sort of thinking from an investor's point of view, but also from a financial advisor's point of view, of course. Okay, next question is from Daniel. Daniel writes, I'm a regular listener to your podcast. I've learnt so much over the last couple of years. My partner and I are both Australian citizens and we're considering moving to New Zealand. Do you have any general considerations for Australians like us or Kiwis returning home who will stop being Australian tax residents and live in New Zealand? I understand they don't have stamp duty or capital gains tax provided you hold the investment property for more than 2 years. Also, the pension, which they call superannuation, isn't means tested. So, Danielle, of course, I can only comment on the Australian considerations. I have I realised they didn't have capital gains tax and, some of the other idiosyncrasies over there in New Zealand, but I'm not an expert in that market, so I'm not even going to pretend to have a guess at what the answers should be. It's difficult when you've got assets in different jurisdictions. You've got to try and find certainly advice in both different jurisdictions and preferably someone that knows both. I think that would be really, really good because then they can balance out, normally it's not just only about tax. There's a lot of other things. Tax is one thing to consider. And so then you want to sort of balance out, those pros and cons. And if you're in the situation, I guess a little bit like property versus shares, right? If I've got the same sort of depth of knowledge in both asset classes, I can then weigh up which one I think you should invest in. Same sort of thing here. So I'm not going to answer your question very well, but I do have a client that is kind of in a similar situation. There's no firm plans, but they suspect they'd like to retire in New Zealand, in Queenstown, in fact, which is just a magnificently beautiful location. And so I can certainly understand why they want to retire there. The things that I sort of think about are for them, buying a home. And I guess it depends on, how far away that is, like when you plan to make that move. But if it is some way down the track, you want to consider relative affordability. And I guess it depends on where your property is in Australia and where you want to live in New Zealand. But if it's potentially in a location that's going to enjoy a lot of capital growth over the next period of time, and if for whatever reason your property in Australia wasn't in a location that was going to enjoy a lot of capital growth, well, then you're going to have a bit of a growth gap there, which could create some affordability problems. So we haven't done it for my clients that is go and buy a home because we felt like we don't really need to, but that's certainly one of the things that I've thought about. And then the other thing you want to think about is when you do become a non-Australian tax resident, as I addressed a little while ago at the beginning of this episode, you're not going to get the capital gains tax CGT discount. And if you're going to make that permanent move to New Zealand, well, then you want to think about in your strategy, what are you going to do with Australian real property? So that is Australian residential property. And I think the answer probably means sell it. It depends on the property and your situation, of course, but it's probably tax inefficient as an asset to hold. So I guess you want to think about that in your strategy as well. So if that move to New Zealand's in the short term, then I wouldn't be buying property now because you might just have to sell it, only after a few years' time. But if you're not looking to make that move for, maybe a decade or more, couple of decades, then it's okay to hold Australian property and invest in it. But they're the main things I think about. How will my investments behave from a taxation perspective in Australia, and then affordability in terms of a home in New Zealand. But of course, there could be a whole host of New Zealand related taxation and maybe other considerations, other financial planning considerations that I'm not aware of, Daniel, so I can't really comment on them. Okay, I'm going to squeeze one more question in from Helen and Graham. Helen and Graham say that our question is about the deliberation over super and assets held outside of super. The background is that we both just into income phase of Q Super and hold 2/3 of the tax-free limit each year. Not really sure what that means. I think what Helen and Graham are saying, they're in pension phase. And I'm not sure about the 2/3 tax-free limit anyway. I'm not sure it really matters for me to answer the question. Number two is that we have an investment house, an investment property that's paid off that gives us around $20,000 a year that we use for holidays. And three, we have an MLC wrap portfolio worth $240,000 that's now only being fed with $100 per fortnight. I think that's their contribution. We pondered the question, should we now retain the wrap portfolio outside super or simplify our retirement by cashing out the portfolio, paying the capital gains tax and placing it into our income stream account where the 2/3 bucket system where we take 4% income and hopefully the pot grows minimum by 3 or 4%. Our deliberation includes all eggs in one basket, simplifying finances as we age, minimal contributions into the wrap platform with fees. Super will be the best vehicle for continuing into retirement. Appreciate you covering this point so all listeners that face the dilemma as they roll into their 60s, what considerations would you give? Okay, so great question, Helen and Graham. The answer is I don't know the all eggs in one basket. I guess all eggs in one basket from QSuper perspective in terms of a fund manager. I mean, but that's a separate decision. Like, you should be thinking about, do we stay with QSuper, periodically to make sure, what are their returns and fees relative to other funds, right? So that's a separate decision. I think the decision, what you're looking at here, the way I would frame it is it's an ownership decision. I've got these assets. What ownership structure do I want these assets in? What I don't know is how much capital gains tax you've got in that MLC wrap portfolio. But what I do know is, and again, this is not personalized advice because I don't know every single detail about your situation, but as a strategy perspective, as a general strategy perspective, I want to try and get as many assets as possible inside super. Now, up until we can all have 1.9 million in super that's tax free. So if I've got a spouse, that's $3.8 million. Well, at least one, by the time I'm in my 60s, doesn't have to be, on your 60th birthday necessarily, but certainly by my mid 60s, I would want to have, if I've got $3.8 million, I'd want to have it all inside super because of course that's going to be the most tax effective. It's zero tax, right? It's not going to get better than that. So I'd certainly want to do that. So in your situation, Helen and Graham, yeah, I'd move the MLC wrap platform, its investments into your super fund. Now, if you've got some capital gains tax issues, so gains tax liabilities, you might want to do that over a couple of years, by the way, and you want to also investigate, whether you've got the superannuation caps to be able to do that, whether it's personal contributions, so concessional contributions, or after-tax contributions, which are called non-concessional contributions. It's going to depend on your individual balances and what your caps look like. But if you don't have, if you've got less than 1.7 each, you're probably not going to have any sort of cap-related issues, in which case you could probably move the money in one hit and put it in the person that has the lower account balance. But again, you might want to do that over 2 or 3 years in order to spread the burden of that capital gains tax. Now, why would I do it? Yes, simplicity, clean everything up. That makes sense to me. Reduce fees and, MLC wrap portfolio. I'm not I don't think it's one of the best wrap platforms out there. It depends, of course, what it's invested in. But yeah, certainly you don't need to pay for those fees. And then also it's going to be a far more tax effective environment. So I can't really see any downsides to doing it. The only thing then is, you're saying you put all your eggs in one basket. It's just making sure that QSuper is going to perform for you. So again, what are its fees and returns relative to other industry super funds? And as you know, if you're listening to the podcast for a while, I do an episode about that in terms of reviewing the top industry super funds every year around the end of July, early August. And so you can always look out for that. But one of the things that we think about is we want to have as much flexibility as possible. So quite often we will accumulate assets outside of super, like a share portfolio. But in terms of longer term outcomes, and certainly once we're in retirement, our annual question to ourselves is how can we get these assets into super tax effectively? And that makes sense in order to do that. So hopefully that answers your question, Helen and Graham, and thanks so much for asking it. I got through a few questions today and there's a lot of good questions in there. So thanks very much. If you do have more questions, you can send them to me at questions@investopoly.com.au. And just a reminder about that report. As I said, if it's of interest, certainly have a look at it. And if you know anyone that would benefit from it, it would be great to share it as well. Thanks very much. And that's it for me. Until tomorrow. Bye for now.